Would you like to see how you could buy $1 worth of assets for 90 cents? Well, even though closed-end funds, or CEFs, have been around in the US for more than 100 years, they're still one of the most misunderstood parts of investing. Most people understand ETFs and mutual funds, but CEFs are a completely different animal. They're often ignored by index investors, yet surprisingly popular with income-focused investors. I actually know people who hold 20, 30, or even 40 of these funds in a single portfolio. And when you see some of them paying 7, 8, or even well over 10% in annual income, the natural question is, what's the catch? Closed-end funds sit in this strange middle ground, loved by some, avoided by others, and rarely explained clearly. They can offer high income and the ability to buy assets at a discount to their actual value, but they also come with some risks and some price movements that aren't obvious at first. So let's take a look at how closed-end funds really work, their pros and cons, why the price behaves differently from other funds, and then we'll look at some of the most popular CEFs to see how they actually perform over time, so you can decide whether they deserve a place in your portfolio. Closed-end funds, or CEFs, sell a fixed number of shares one time through an initial public offering or IPO. After that, the fund is generally closed, meaning no new shares are created and no new money flows into the fund. This creates a stable bucket of capital that the manager can invest without worrying about investors pulling money out at the wrong time. That's very different from open-ended funds like mutual funds and ETFs, which are designed to accept new investment capital on an ongoing basis. Mutual funds trade shares directly between you and the fund itself. When you buy a mutual fund, your money goes to the fund company, and new shares are created at that day's net asset value, or NAV. When you sell, the fund redeems your shares at NAV and sends you the cash. All of this happens once per day when the market closes, and you're always transacting with the fund, not with other investors. ETFs work differently. ETFs trade shares between investors on the exchange, just like stocks. When you buy or sell an ETF during the day, you're usually trading with other investors, not directly with the fund. The price moves throughout the day based on supply and demand. But there's an important backstop. Large institutions can create or redeem ETF shares directly with the fund. That mechanism helps keep ETF prices tightly anchored to their net asset value. But closed-end funds are where the rules really change. Like ETFs, CEFs trade between investors on the exchange. But unlike ETFs, there is no creation or redemption mechanism to keep prices in line with the NAV. The number of shares is fixed. That means CEF's share price is set entirely by investor supply and demand. As a result, the price can drift far from the actual value of the assets inside. Sometimes it trades at a premium above the NAV, and other times at a discount below the NAV. Buying at a discount can add extra upside if that gap narrows, while buying at a premium can increase your downside if the sentiment shifts. Let's break down the pros and cons of CEFs, because in the market, every advantage comes with a trade-off. Here's the pros and why investors like them. The discount. As I mentioned, you can often buy a CEF for 8 to 10% less than the value of the assets inside. That's like getting extra assets for free. The high yields. CEFs pay 8 to 10% or sometimes even more in annual income. Fully invested management. Since investors can't pull money out, managers don't have to keep cash on the side as a cushion. They can stay 100% invested, even if the market is dropping. Then sometimes there's access to unique types of assets. Their structure lets them buy things ETFs usually can't, like private capital, niche municipal bonds, and specialized international securities. So now the cons, so you can watch out for them. There can be high fees. It's not just the management fee. Many CEFs borrow money, so interest adds up. Sometimes the total expenses on some funds can run from 2.5 to 5%. However, when you see the yield a CEF pays, it's usually already net of these fees. Then there's leverage, which can amplify losses. Borrowing works great when markets rise, but it can magnify losses when markets fall. And anytime there is borrowed money involved, the fund is more sensitive to interest rate hikes. Then there's some price volatility. Since the share price is set by investors, not the actual asset, a panic can make your shares drop more than the underlying holdings. Return of capital. Some CEF funds pay part of that high dividend by simply returning some of your own money. If it happens too often, it can slowly erode the fund's total value of NAV. And sometimes the percentage yield you earn over time can vary greatly. The bottom line, CEFs can offer income and opportunities you won't find elsewhere, but some are more complex and riskier than the typical ETF or mutual fund. They're not for everyone, so it's important to understand how they work before you jump in. Now, if you want to start researching some of these, a great place to check out is CEFconnect.com. You can set up a free account and dig into different CEFs. There are hundreds out there, but let's take a look at 4 popular ones. These aren't personal recommendations, they're just solid examples that give you a feel for the variety out there and what to look for in a CEF. And just like with stocks, ETFs, and mutual funds, there are some really good ones and some ones you'll want to avoid. First up is ADX, the Adams Diversified Equity Fund. It's been around since 1929, and it's basically a higher yielding version of the SP 500. It already holds the big names you already know, like Nvidia, Microsoft, and Apple. But because it's a CEF, it often trades at a 6% to 10% discount to the value of its assets, which it did through most of 2025. By early of April in 2026, the discount had shrunk to about 3.5% though. ADX generally does not use leverage, so it's not borrowing money to boost returns. Its total fees were only 0.49% in 2025, and that's actually lower than many standard mutual funds. It's actually a great example of how the CEF structure can sometimes let you buy blue chip stocks for about 90 cents on the dollar without taking on extra debt risk. Over the past 3 years, the discount to NAV has ranged from roughly 3% to 16%, which shows how opportunities can pop up to buy it at a deeper discount. You can see how it varied during the last year in this chart, showing the discount to NAV. And as of the first quarter of 2026, it's paying around a 7.75% annualized distribution. Now let's look at performance, because this is where CEFs can get a little confusing. Over a 10-year period ending in March 1st, 2026, ADX had an annualized price return of 16.36%, which is the bar you see on the left. Over that same period, the NAV returned an average of 13.69%. Here's the key difference. The NAV return shows how the fund's underlying assets performed, based purely on the portfolio itself, including reinvested distributions. But it ignores whether you bought the fund at a discount or a premium. The price return is your real-world scorecard over that 10-year period. That's what you actually would have earned buying and selling shares in the market. When the price return is higher than the NAV return, it means you just didn't benefit from the assets going up. You also benefited because the discount premium narrowed while you held the fund over that period. For comparison, the S&P 500 averaged about 14.2% over that same 10-year period. ADX slightly trailed the S&P 500 at the NAV level, but because the discount narrowed over time, investors who held it were helped on the price side. For the one-year period ending March 31st of 2026, the NAV return was 17.39%, but the price return was 25.52%. That's because the discount narrowed over that period, and you can see that in this chart. And this really highlights one of the unique opportunities with CEFs. Investors often look to step in when the discount is larger than normal, hoping not only for solid performance of the assets, but also for that discount to eventually close. And just like the market itself, CEFs can have bad years. In 2022, for example, the S&P 500 was down 18%. The total bond market fell around 13%, and ADX price dropped 19.84%. Next up is BST, the BlackRock Science and Technology Trust, which is popular with investors who want growth, but also like the idea of a monthly check. The fund owns high-growth technology stocks, and as of early 2026, it was paying about a 7.25% annualized yield, partly generated through a covered call strategy. Because of that covered call approach, BST gives up some of its upside potential in strong bull markets in exchange for more consistent income. It's a good example of a CEF that again does not use borrowed money, but instead uses options to turn tech volatility into cash flow. During 2025, its discount to NAV ranged from about 9.08% to 1.36%, which again shows how opportunities can appear to buy the shares below the value of the underlying assets. BST does not use leverage, and its total management fees through 2025 was 1.11%. As of March 31st of 2026, BST's 10-year annualized return on the NAV is 16.54%, while the 10-year annualized return based on price is 17.17%. That gap reflects a period where the market discount narrowed, which boosted investor returns. That said, because this fund is more tech-heavy, it also experienced much larger losses in 2022, which it dropped over 38% in a single year. Once again, these funds are not immune to volatility. Compare this to a growth fund like QQQ, which had a 10-year return of 19% over the same period and dropped a little over 32% in 2022. Next up is Liberty All-Star Equity. The ticker is USA. This one is a little bit different because it's managed by multiple investment teams, each with their own style, like value and growth. USA has a very popular policy where it tries to maintain paying about 10% of its value each year in distributions. Because of that, it's often used as a core holding by CEF investors, since it provides broad diversification in a single ticker. Over the past year, it's traded at a discount to NAV ranging from about 1% to 10.75%, which again shows you how opportunities can open up when the discount widens, or in this case, work against you if you have held it during those periods. Its annualized distribution rate early in 2026 is around 10.3%, and total management fees run around 0.91% for the year of 2025. While the yield is higher than the first two funds we looked at, the long-term returns are a bit lower. Over the past 10 years, ending in March 31st of 2026, the annualized total return is 12.03% based on the price and 10.78% based on the NAV. Finally, there's CSQ, the Calamos Strategic Total Return Fund. This one is a hybrid fund, meaning it holds a mix of stocks and bonds. It's also a good example of a CEF that does use leverage. CSQ borrows money to help boost returns and income, around 28% effective leverage early in 2026. That leverage can enhance yield, but it also makes the fund more sensitive during volatile markets. Over the past year, ending in March of 2026, CSQ's share price has traded at a discount to its NAV, starting at around 2.25% and increasing that discount to about 10%. Its annualized distribution rate is around 7.63% in early 2026. The total management fees run roughly 3.69%, which reflects both management cost and interest expense tied to that leverage. Looking at longer-term performance for the 10-year period ending in March of 2026, CSQ's annualized NAV return is 14.49%. while the price return is 15%. In 2022, even though it did hold bonds, the fund dropped 24.22%, highlighting how leverage can amplify the downside during tough markets. Because CSQ blends equities and income securities and uses leverage, it's an example of a CEF designed to deliver higher income, but with added complexity and risk compared to simple unleveraged stock or bond funds. Of course, there are many other closed-end funds I could have highlighted, like STK, FFA, or EOI, and many others. But these examples should give you a solid feel for how they work and why they're such a unique corner of the market. There are some good ones out there and some you would want to avoid. The key takeaway is CEFs are just another tool some people like. They can make sense for some more experienced investors who understand discounts, leverage, distributions, and who are comfortable keeping an eye on what they own. Some investors even use them as the core of an income-focused portfolio, but only after understanding how they work. As always, focus on what fits your goals, your time horizon, and your risk tolerance. And if you want to explore CEFs further, take time to understand how the income is generated and why the share price behaves differently than ETFs and mutual funds. That understanding is what separates smart use from costly mistakes. If you want to dig deeper, CEFconnect.com is a great resource for researching closed-end funds. I'd also love to hear from you. Have you used CEFs before, or do you currently own any? If so, share your favorites in the comments below. And as always, thank you for watching. Don't forget to hit the like button.